Hello, welcome to my channel. Today's topic is National Income Accounting. National income is expressed in aggregates. As I have mentioned earlier, national income is the total money value of all the final goods and services produced in a country in an accounting year. As you know, the grains like wheat and rice are produced in kilogram. They are measured in kilogram. Milk is expressed in liters. When we say 20,000 computers are produced in the country, we just say 20,000. Regarding mobile phones, 5,000 mobile phones are produced in the country. So all these can be expressed in money value. That is why national income accounting, it is expressed as money value of all the final goods and services produced in a country in an accounting year. Accounting year is from April 1st of year to March 31st of the next year. And national income is expressed in aggregates, as I have mentioned earlier. Is GDP at market price, GDP at factor cost, NDP at market price, NDP at factor cost. Then GNP at market price, GNP at factor cost, NNP at market price, and NNP at factor cost. So 8 aggregates are there. GDP at market price, gross domestic product at market price. Gross domestic product at factor cost. Net domestic product at market price. Net domestic product at factor cost. Okay, so what is this G? It is gross. What is D? Domestic. And market price. MP is market price. What about the next one? Again G, gross, D, domestic, GDP, that is gross domestic product. P means product. Then FC, it is factor cost. So D is domestic. What is N? That is net concept. So here gross concept, domestic concept, market price, factor cost, net. So what is the difference you see here? Instead of domestic product, you can see national product. Gross national product at market price. So here these are concepts of national income. And these are concepts of domestic income. These 4 are GDP at market price and factor cost, NDP at market price and factor cost are concepts of domestic income, gross national product at market price, gross national product at factor cost, net national product at market price and net national product at factor cost are concepts of national income. Now, how can we calculate these aggregates? These 8 aggregates. Why is it known as domestic income? Why is it called national income? So, gross includes depreciation. The gross concept includes depreciation. Gross includes depreciation. What is depreciation? Depreciation means the normal wear and tear faced by the fixed assets like machines. With continuous use, its value will be reduced. Every capital asset faces it. We can take the example of a computer, mobile phone, vehicles. Its value, it is a capital asset. Its value, it decreases with the continuous use. So, it is called depreciation. So, gross includes depreciation. What is depreciation? It is a normal value of the normal wear and tear faced by the assets like machines. And every firm, it sets aside an amount for depreciation. It is called depreciation cost. For the maintenance of the machines, depreciation cost is incurred. So, gross includes depreciation. When we deduct depreciation from gross, we get net concept. Gross minus depreciation is equal to net. Therefore, when we add depreciation to net, we will get gross. So, gross minus depreciation is equal to net. Net plus depreciation is equal to gross. So, this way GDP at market price and NDP at market price. We will see it one by one. GDP at market price, NDP at market price. How can we derive it? So, gross minus depreciation net. So, GDP at market price minus depreciation, we will get NDP at a market price. So, one by one, we are going to see this concept. So, gross includes depreciation. Gross minus depreciation is equal to net. So, GDP at market price minus depreciation is equal to NDP at a market price. So, gross becomes net by reducing depreciation. So, NDP at market price plus depreciation is equal to GDP at the market price. Okay. Now, what are the other terms for depreciation? Depreciation is otherwise called consumption of fixed capital. Consumption of fixed capital or current replacement cost. Or replacement cost of fixed capital. Okay. Depreciation, the other common term is consumption of fixed capital or current replacement cost of fixed capital. These are the terms. So, while the problems are given in the, while the terms are given in the question paper, sometimes instead of depreciation, consumption of fixed capital will be given. Both are same, or current replacement cost or replacement cost of fixed capital. So, gross minus depreciation is equal to net. Therefore, net plus depreciation is equal to gross. So, gross minus net is equal to depreciation. So, gross means the value of the product including depreciation. It is the capital consumption allowance. Depreciation is otherwise called consumption of fixed capital or current replacement cost or replacement cost of fixed capital or capital consumption allowance. So, depreciation is known in different names. While the firms use machines, it means normal wear and tear with continuous use. So, a cost is incurred for the maintenance of these assets like machines. So, depreciation or consumption of fixed capital is a expected decrease. That's very important. Expected decrease in the value of fixed capital asset due to continuous usage because of its general use. It is a result of production of goods. So, while the firms are using the assets like machines continuously, it means with normal wear and tear, and a cost is incurred to maintain that. That is depreciation. So, while we are using a computer or a mobile phone, or it can be furniture, it can be machines like we use at home, washing machine, grinder, it can be any asset. With continuous use, its value decreases and a cost is needed for maintaining it, for replacing it. So, that is current replacement cost or consumption of fixed capital. So, gross includes depreciation. Gross concept includes depreciation. When we deduct depreciation from gross, we get net. So, naturally, net plus depreciation is equal to gross. So, difference between gross and net is depreciation. Next is market price and the factor cost. So, what is market price and factor cost? I have already explained. Factor cost is the amount paid to factors of production. Which are the factors of production? Land, labor, capital and entrepreneurship. So, this amount is paid to these factors of production in the form of rent, wages, interest and the profit. So, rent plus wages plus interest plus profit, we get total factor income, and this is paid to factors of production, that is land, labor, capital and entrepreneurship, for their contribution in the production process. So, what is market price? Market price, it is the price at which the product is sold in the market. It includes taxes. It includes net indirect tax. What is net indirect tax? Indirect tax minus subsidy. Okay. So, market price, it is the price at which a product is sold, actually sold in the market. It includes net indirect taxes. Net indirect taxes is equal to indirect tax minus subsidy. What is indirect tax? GST, goods and service tax. Then sales tax, customs duty. So, that indirect tax is payment to government from the public. It is a payment to government. It is a revenue to the government. The tax is a revenue to the government. But subsidy is payment from government. Payment from government. It is in the form of financial grant. And it is provided by the government. It is sanctioned by the government in order to boost the production of certain goods, in order to boost export, and it helps the public to get certain products at subsidized price. That is at a price lower than the market price. Example, LPG cylinder is given at subsidized rates by the government. So, market price includes net indirect tax. Factor cost does not include net indirect tax. That means market price minus net indirect tax, we will get factor cost. Factor cost plus net indirect tax, we will get market price. So market price minus net factor cost plus net is equal to market price. So the difference between market price and factor cost, we will get net indirect taxes. Next is national income and domestic income. What is national income? It is the net money value of all the final goods and services produced by the normal residents of a country during an accounting year. What is the meaning of normal resident? It is given in detail in the notes already uploaded. Kindly refer it. Normal resident is one who is born in that country, in a particular country, and whose economic interest lies in that country. That is, he is doing all the economic activities, production, consumption, investment. It is happening in that country. And normal resident can be one who is residing in a country for more than 1 year and he is doing all these economic activities in that particular country. Okay, so national income, it is the income generated by the flow of production of goods and services by the normal residents during an accounting year. So what is domestic income? It is the total factor income earned by the factors of production, that is already mentioned, by the factors of production in the form of rent, wages, interest and profit within the domestic territory of a country during an accounting year. The meaning of domestic territory is also given in detail. So domestic territory, it is not the geographical territory. Domestic territory is one where a country, its government, it has administrative jurisdiction. So domestic territory, India's domestic territory, economic territory, it is India, the geographical territory, plus wherever the Indian government has direct administrative jurisdiction. For example, Indian Embassy in Russia, all the officers are appointed by the government of India. They are answerable to government of India, and Indian government has the freedom of movement of persons, good and capital in its economic territory. But Indian government has no administrative jurisdiction in the Russian embassy located in India. Russian embassy located in India is answerable to Russian government. So kindly read my notes regarding domestic territory in detail. So what is domestic income? It is a total factor income earned by the factors of production within the domestic territory of a country during an accounting year. So how can we calculate national income from domestic income? For that we require NFIA. National income and domestic income. Domestic income is NDP and factor cost plus NFIA. We get national income. So what is NFIA? Net factor income from abroad. That is factor income paid to abroad, factor income from abroad. The difference between the two give us NFIA. Factor income from abroad minus factor income to abroad gives us NFIA. So if factor income from abroad is less and factor income to abroad it is more, NFIA will be negative. So in order to get a positive net factor income from abroad, factor income from abroad should be greater than factor income to abroad, and factor income from abroad is to be added, and factor income to abroad, whatever income is given to abroad, it is outflow of income from the country, it is to be subtracted. So domestic income, NDP at factor cost is a standard unit for domestic income plus NFIA. We get national income. NNP at factor cost is the standard measurement of national income. So domestic income, national income, market price, factor cost, gross net concepts. This is to be thorough. Before we start the calculation, now we are going to start with the value added method.